Okay, here's the buzz, here's the deal, here's what's happening. Sales tax payable is a super easy concept. Depending on what state you live in the United States, you have a certain sales tax rate. So when the retailer sells the goods to the final consumer, they collect a sales tax rate on top of the sales price. In California, it can be as high as 10%. So the concept is pretty simple. Sales taxes are expressed as a percentage of the sales price. The last person in line, the last person to sell it to the customer, turns into a tax collector. And we keep track of the original sales price and the tax that we collected on top of that. And then we remit the collections. We send that tax to, in California, it's called the Board of Equalization. And we have to do it every quarter. And the only tricky part of this whole thing is this sentence right here, this phrase. The company enters the tax separately in the cash register or includes it in total receipts. We'll get to that in a second. Let's do a simple example. We have a cash sale. We sell something for $100, and let's say our tax rate is 6%. Cash is an asset. Assets increase with debit, so we debit cash for $106. The sales price is $100, and then we create this liability account called sales tax payable. Sales tax payable is a liability account, so it makes sense that it would increase with a credit. And so in this case, we're keeping track of our sales and our sales tax payable in separate accounts. So there's no such thing as sales tax expense in this example. We're just a tax collector. So now it's the end of the quarter. It's time to remit, to turn over the sales tax that we collected. Sales tax payable had a credit balance of $6 for us. So to make it zero, we debit it for $6. And we write the Board of Equalization in California a check for $6. Cash is an asset. It increases with debits and decreases with credits. And that's all there is to sales tax payable, except that accounting textbooks like to pretend like we're back in the 1950s and we have a cash register that can't keep track of sales and sales tax. So for some reason, accounting textbooks love to give you the total proceeds and expect you to break it into sales and sales tax. So remember, total proceeds, 106, equals sales, 100, plus sales tax of 6. Another way to express that is total proceeds equals sales times 1 plus the tax rate. So in this case, it would be $100 times 1 plus 06. So our total proceeds are 106. So in this algebraic equation, we divide both sides by 1 plus the tax rate, and we discover that total proceeds divided by 1 plus the tax rate gives us our sales. So if in a homework problem the book gives you the total proceeds, simply divide it by 1 plus the tax rate, and that'll tell you the sales. So for example, if the book tells you that the total sales were $20,520 and the sales tax rate was 8%, you take the total proceeds, divide it by 1 plus the tax rate, and you discover that the sales are $19,000 and the other $1,520 must be the sales tax. Anyway, the point is that sales tax payable is super simple. If we're the last person in the line, if we're selling the goods to the retail customer, we become a tax collector on behalf of the state, and we have to book that liability at the time we make the sale. Hope that helps.